Well, happy Wednesday. Welcome back. It is that time again for another information packed episode on Ready, Set, Real Estate. How are you? Let me do this before we jump into today's presentation. Let me go like this. How are you? How are you? DJ, let's bring that down a notch for me real quick. Thank you very much, very much. All right, good stuff. Hello, 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 everyone. How have you been? I trust Veterans Day um, was a special day that you took that day to remember our veterans and those who continue to fight, have fought for us, and that's why we did not broadcast last week. So today I'm back. We're going to continue off and finish our series. We are doing the homeowner or property owner empowerment series. Stay tuned for um, top tips on how to best monitor your mortgage. All right, so stay tuned for that. 5 tips to monitor your mortgage. For those of you who are continuing along, thank you. Welcome back. I know you are taking great notes. We are going to do classroom style, or I should say, we'll continue classroom style and conclude this season, like on season 7, over 150 something episodes. I am calling it episode 13. It might be episode 13 or 14. But today we are going to wrap it up with the last option as we talk about those who are facing financial hardship. Now, you know how we do it here, right? So drop down in the comments below. Please press 1, lets me know you're here. Press 2, lets me know you shared it. 1 lets me know you're here. 2 lets me know you're shared it. And what else? If you have any questions, go ahead and let me know. You can send me a message. You can inbox me. Feel free to do that. And welcome to those who are new listeners. My name's Lisa Puerto. I'm also founder, creator of many cool things, books, projects, curriculums. I am show host. I am also an active California broker and owner. Been in this industry, training agents, just having a great time. And the more I do it, listen, the more transactions you do, the more involved you do. This business is just always learning, always learning. So this year has been a very interesting year for me. I'm learning so much. I've got a couple transactions that have just really shown me a lot. And I'll share more with you on that once they've closed out and finalized. I don't want to talk too much about in details and stuff like that because it's still going through. There's one that is headed towards mediation / arbitration. And I like to talk to you real transparently about what most people won't talk about in real estate in the business. Everyone talks about the rainbows and butterflies story, how wonderful it is, how perfect it is, and all this other stuff. But listen, real estate has its good, bad, and ugly. And you can or should have an indifferent position about it as you go through with it. So I do say that, because you should be empowered to know these things can go different directions. And sometimes it's what you don't know is really what truly hurts you. And then you just got to get with somebody that's solid. Miss Tamika Adams, she says, I'm here. Hello. How are you? Shout out to Tamika Adams. This is a great connection that I've made over the years. So I'm really, really happy about that. Yeah, so I'm really happy about that. Let's see, what else? I think that's about it. I think that is about it. Okay. So today, as I said, we covered over the last couple weeks. We are in part 7. We talked about, for those of you who you or someone may be experiencing financial hardship, especially as we're going through this COVID, right? Experiencing the turbulence of COVID-19 that it is creating in our economy and financial industry. And of course, the employment status of those, especially our wage workers, our hourly workers in the restaurant industries, entertainment industry was hard hit. I mean, that was quite a flip on a switch for those who were in those industries as well. So every industry to a certain degree has been impacted. Some have done well than others. Some are continually thriving. And that is what is interesting for me as I continue to pay attention to what the market is doing, is that, prices have, we are in this window right now where prices are experiencing an uptick. And so we were discussing with colleagues and investors and developers, everyone, in that pool of circle, where one position is, oh, it's a seller's market, and another position says it's a buyer's market. And the buyer's market position is because interest rates are so low, relatively low. Remind you, for those of you who are looking at interest rates at 2.9 and 3.2 and even 4 points, right? You're definitely going to appreciate the days of 4 points, 4% interest rate. The reason why I bring up rates right now is because you really take for granted what you do not know. When my folks purchased 20, 30 years ago, we're talking about interest rates at 8 to 12%. That was a norm. Interest rates at 8 to 12%. So I always say or preface relative, right? Interest rates are relatively low. What does relative mean? Relative to the times, relative to the cost of living, relative to what's going on with inflation, relative to the present moment. You can't say, interest rates are low, because back then that was low too. Last year, interest rates were low. Back then, interest rates are low today. They may not be low tomorrow. I say that because what goes up must come down, and what is down already eventually must go up. I have to say that for those of you who are watching interest rates, not saying that interest rates are going to go up tomorrow, but I do want you to know that that is the relationship of price and interest rates. Right now, for people who are saving and using money markets and CDs, they're taking a licking, right? I'm like they, as if not, I'm not included. I mean, yeah, I'm not getting quite a return, hardly anything on my money market accounts. The interest rates are just, yeah. So I say that because it's important to diversify your portfolio and not be relying on quote unquote saving. Definitely diversify. Do pay attention as we are, moving into territory with these markets are very symptomatic of what it's been during the financial housing crisis of 2008. I say that because we have a lot of the same things in place. We have a lot of the same, it's very symptomatic for me. So I say that to do what's right, do what makes financial sense for you and your family. Look at your numbers, look at your situation, and decide if this makes financial sense for you. All right. So let's shift into, as I'm talking about the economy, the markets, let's shift into, as we move into financial sense. What makes financial sense? So, we're going to do classroom style today as we continue this webinar here. And yeah, it's late. So shout out to those of you who are tuning in on the East Coast. I know, what is that? That's like 9:40. Forgive me for coming on so late today. Please forgive me. I've had a long day. I almost didn't go on, but I was like, nope, I'm committed. I'm committed. I easily did over 200 episodes straight every week for the last year and a half, and I'm back. So I'm definitely back, and I'm committed. We are also going to be bringing our classes back. So third Saturdays of each month, which means I have a class coming up on the 21st. I may have to move that, you guys. Our class schedule, we had a great class schedule mapped out for the year, and we had to make some adjustments. But we are going to bring that back. So this month's class is supposed to be on deed and fraud as it relates to, fraud and mortgage fraud and fraud in deeds. Unfortunately, I have been hearing and experiencing and seeing a lot more of that. So people that I'm actually assisting in person, in, live. They've seen the marketing I did for that, and were asking me about it because they're all dealing with a similar situation as it relates to deed fraud. And this is deed, fraud on your title or fraud on your deed, even mortgage fraud. So I think it's our webinars are normally uh, 20-25 bucks. Members, you do have access to those webinars, when you subscribe and sign up. But that one, I think I'm going to open that up to everyone just this month, just to kind of get us back on board. So I'm going to gift you that one. I think it will open a discussion to a lot of people who are experiencing fraud across this country. New York is one state that it has experienced an increasing amount that it's actually on their department of I forget the name of their bureau, but they have an alert going out to homeowners about those fraudulent deeds and people who are coming and scamming. And it's a wild, wild west out here is really what's going on. So that's what's coming soon. I'll set the time. I'll let you know. Stay tuned. Make sure you're on the email list. All right. Make sure you subscribe. That way you can get the notification. And even if you're, followed here, so you won't miss it out. You won't miss out. I got you. I got you. Okay. Deed in lieu of foreclosure. So let's recap. If you've missed what we have been going through, we are now in part 7 of a series, a property owner empowerment series. And it's really, for those of you or family, friends, or loved ones that who have been experiencing financial hardship as it relates to their property, they do have options. And I said, when I consult with people, selling is usually the last resort, right? Selling a property for me in my consultations is the last resort as we go through the checklist of options available to a homeowner client. And then I support the decision. And sometimes you've got to just be a matter of fact with people. You got to just be really factual because it is not an easy decision to come to say that now I've got to sell. I've now got to look at relocating. Where am I uprooting my life? Where am I changing? And that whole process and experience. So I recommend that you find someone, albeit someone like me, my team, or someone like myself, that you can consult with about what your options are. The reason I'm talking about this is because I know there's so many people that don't know what their options are. So let's recap them. Number 1 is when you have missed your mortgage payment and you are falling past due. If it's just 2 or 3 payments, you can do a repayment. That's option 1, right? So do a repayment and basically just pay back what you owe. If you continue to fall behind, you're 3 to 6 months, 3 to 9 months behind, you can do what is called a reinstatement, right? So reinstate that. They'll work with you on creating a payment plan, a very short-term payment plan, and then you kind of, pay all in full. So that's what you'd be seeing a lot of that. You see repayment plans. The third option is forbearance. Forbearance plans are similar to where it's added on the back end. In other words, depending who you have, who owns your loan, we talked about the GSEs, Fannie Mae, Freddie Mac, VA insured, VA guaranteed loans, the United States Department of Agriculture, the USDA loans. Those type of insured and guaranteed loans do have additional protections for homeowners as it relates to that. Namely, they are not requiring balloon payments, meaning, you don't pay for X amount of months and then they're wanting you to pay, the past due all at once. But you've got to call and find out if that's the type of loan that you have. And then you have, once we talked about the forbearance, we talked about loan modifications. So modifying the terms of the loan, and, that's a whole process, and that does not guarantee. And in all of this, we're discussing this about dealing with the mortgage servicer and mortgage lender, it's important that you understand the difference, right? So every time I start this topic, I want to make sure we revisit again what is a mortgage lender versus what is a mortgage servicer. It's important to know the difference. Know thy difference. So as I covered forbearance, and then the last one we did last week was a short sale. So that means that you've exhausted those options, and then you owe more than what your home is worth, and you would consider selling. You then work with the mortgage servicer to then start the approval process for short sale of the property. You can negotiate relocation money. There was, during the last administration, there was a program that was great for that. I believe that was under the HARP program. And just a lot of benefits did come out of that, as you know, a great majority of the nation was experiencing that. So people were able to get money, even though you're not supposed to get money from the sale of a home during a short sale process. That is, the owner is not. They were able to get relocation money, meaning enough money to move, right? The cost of moving and deposit and first month's rent, that kind of scenario, to just kind of get them shifted out of the property. And today we're going to talk about deed in lieu of foreclosure as one of the last resorts available when you're experiencing financial hardship as it relates to homeowners or property owners. Before I delve into that, before I continue in that, let's talk about mortgage lender versus mortgage servicer. It is important for you to know that in the business of real estate, and namely or specifically in the business of making loans, you are your loan is part of, you know, the investors or the secondary market buying your loan, right? So oftentimes you're signing paperwork that says, you know, hey, we are underwriting your loan, we're funding your loan, but we may decide at a later date to sell your loan to someone else. And that happens very regularly in real estate. I anticipate there is a large volume of loans being packaged right now, sold and packaged very quickly, you know, at these low interest rates, as people are getting in, taking advantage of rates, purchasing these properties. And, you know, we see those loans are being packaged and sold. And so with that, you know, comes what is called a mortgage servicer. They're essentially the middle person that is overseeing the accounting, right? They're collecting payment from you. They're applying it to your loan account. The reason why it's important to know the difference is because during the financial crisis of 2008, what was experienced or exhibited from that period is that mortgage servicers were not properly reporting payments. And it contributed to the foreclosure crisis, or the housing crisis, where many homeowners who were on time, who were paying, were now experiencing, you know, payments that were not being reported. So that in itself is, you know, it created an issue, right? Grady, thank you for chiming in. Grady says, I'm here. Thank you very much for letting me know that you're here. Welcome. Class is always in session on Ready, Set, Real Estate. And so it's important to understand the difference between mortgage servicer for that reason, is because oftentimes when I speak to clients about, you know, what they owe, let me see the statement, they think the statement is coming from their lender. No. When you call, oftentimes you think you're talking to the lender or the investor who owns the loan, but you are not. You are talking to the mortgage servicer. They are communicating between you and the investor. Do know the investor will always have the final say. Unless you hire an attorney and you file suit or countersuit, who may say otherwise, right? And that's a whole nother discussion. I had a great show on ways to actually stop a foreclosure, and you can go down my YouTube channel and look in the archives. I don't remember the episode. There was a guy who came on, and he specializes in that. And the way he legally was doing that was by countersuing the foreclosure based on claims of paperwork or requests for paperwork or evidence or forms in the documents, right? So that's a whole process. I don't recommend you do that alone if you're going to countersue the foreclosure, because foreclosures are legal actions. So I think it's great we talk about that right now. Okay. So mortgage lender versus mortgage servicer, we're good. If you're not clear, see me after class. Right? See me after class. But it's important to know the difference, okay? Because as we talk about five ways to monitor your mortgage, it's important to know the difference. Okay, very good. Let's jump into it. Moving along. Let me get that down. All right. So deed in lieu of foreclosure. Let's just talk about definitions. So, I'm all about definitions. It's so funny that, we were doing a real estate word, every week we were discussing new real estate words. So let's talk about foreclosure. Because oftentimes I think people learn about foreclosures from, oh, I want to buy a foreclosure. I want to buy a foreclosure. What is a foreclosure? Anybody want to chime in? What is a foreclosure? What is a foreclosure? By the way, I didn't get to shout out my YouTube folks, right? So shout out to my YouTube subscribers, viewers, and listeners at chiming in at youtube.com/LA Super Agent. I'm LA Super Agent on all my pages. So Facebook, Twitter, Instagram, YouTube, and including on radio podcasts. You can keyword Ready, Set, Real Estate, and, subscribe to the radio podcast. There's some bonuses on the radio podcast as well. So, definitely I would chime in there. I did an entire entrepreneur series when COVID first happened. I gifted about 16 classes, and that's available on the podcast only. If you'd like to get the video and the whole presentation and the notes, you can subscribe or you can sign up for that and purchase that, and check out lasuperaagent.com for that. So what is a foreclosure? Great. Grady says process. I'm so glad you mentioned process. Tamika adds the result of non-payment on a mortgage, ? Yes, very good. So yes, so it is both that. It is a legal process. Let's go back to Grady's and we'll build on that. So it is a legal process as a result, right? So it's a legal process in terms of the mortgage. When you signed your loan paperwork, your loan docs, in your loan docs, you gave the beneficiary, which is the investor, the owner of your loan, you gave them the right to sue you and use the home, the property, as collateral. That's called a secured note. It's a secured note. The property is collateral to recover payment for what Tamika says, non-payment on the mortgage. So essentially, you created a mortgage. And let's talk about definitions again. Mortgage. What is a mortgage? You mortgage the property, especially when we play Monopoly. I think we take for granted that when you bought cash. So notice this, right? You're paying when you play Monopoly, right? By show of hands, we're familiar with play Monopoly. If you haven't checked out my Monopoly, the real game of Monopoly on my Facebook or YouTube, I did a special presentation about the history of Monopoly. And if you knew that the original name for Monopoly from the 1900s, 1902, it was known as the landlord's game. If you knew then that it was called the landlord's game, my question is, would you play it differently today? And even I break down what the pieces mean. and the significance of that game. So I recommend, if you have not watched that special presentation that I did on the real life game of Monopoly, go ahead and check that out. On my YouTube, you can probably type in real life game of Monopoly. It'll come right up for you. And I got a lot of great feedback of a lot of people that were, it brought a lot of emotional, some were angered to know the truth of what Monopoly really was or is about. So with that being said, notice that when you play Monopoly, you're paying cash, right? You buying the land cash, and then you're building up your, you owe all the land. Then you start to build up your properties on once you own all the land. But notice when you are starting to have to pay other people for landing on their land, and you're paying them rent, you're paying taxes, you're paying the fees, you're paying all these other things, right? And you're depleting your liquid, uh, your liquid assets or your funds, right? The money that you hold. You then start to borrow against your property, or in other words, you mortgage the property for a percentage of its value. Same thing. So mortgage that you've taken out because you didn't have 97% of the purchase price. You instead bought 3% down, 0% down via loans, or seller financing, or 3.5% down FHA insured loans. You can do 3% with a conventional loan today. Yes, you can. Gone are the days of 20% conventional loans. You can, with a, my lenders let me know with a credit score of, I think it's 720, 740, you can do a 3% conventional loan. So 3% conventional loan. So you brought 3%, bank kicked in 97%, you mortgaged 97% of the loan. They said, hey, that's fine. You're going to pay us over this period of time at this interest rate. If you don't pay us, you're signing paperwork that says, in the event that you don't pay us, we are going to sue you. And we're going to do that in one of two ways. It's called a judicial foreclosure or a non-judicial foreclosure. They're two different processes. Guess what? I also did an entire show on judicial foreclosures and non-judicial foreclosures, so that you knew the difference between a trustee sale and a sheriff sale. You see how I got you covered? Listen, I got you, because you also should know the difference. Judicial foreclosures makes it expeditious, right? And you can't come back and say, oh, I'm going to recover my house and pay all the past due amount. So you're signing paperwork that pretty much is signing away that right and that ability to do that. Now, it depends on the state you're in. That's why it's important to know whether your state is a judicial or non-judicial foreclosure. And it's usually governed by the state, and it's governed by what is stated in the loan documents. So it's important to know that, because if it's done by way of, going through the court process and trial and all that, and then it's decided on that they foreclose on you, they gain your home in lieu of settling the debt, you then do have the ability to come back, and it's a year, within 1 year, to come back and say, look, I came up with all the money plus court fees, here you go. So I say that too for people who buy foreclosures. You need to understand the rules of the land. The laws of the land is what I say. So I shared a lot, but that's all, that's, usually what I do. So forgive me, because I've touched on a whole lot right now. I touched on foreclosures, mortgages, trustee sales, and share sales, judicial and non-judicial foreclosure processes, as we're talking about what is a foreclosure. Okay. So the question you have to ask yourself, and you being the person in default, and by way, foreclosure is the process from 0 to 180 days. Some states are 0, say 0 to 90 days. But in practicality, because they're, especially right now, as a matter of fact, with this moratorium, uh, courts being closed and things have been on pause, expect things to ramp up March 2021 as it relates to court being open, uh, foreclosures to start to be underway. We, if it is seen that we are then moved into a new democratic, or I should say new administration, which is a democratic administration or presidency, I anticipate, this is my opinion, this is not fact, that we will more than likely see extensions on moratoriums. We will see a lot more tenant protections. We will see a lot more things put in play that, crosses over, you know, state, government and state making decision for owners as it relates to their properties. And that's what we were seeing already. I'm in California, so our governor is a Democratic governor. So, and we're known, blue state, that kind of stuff. So we've seen a lot of involvement of the state as it relates to deciding what property owners are to do in these types of situations. So be mindful too when as you're voting and you're picking administrations, that one party favors more government involvement, and other parties favor less government involvement, and let local ordinances, the state and the people decide. But when you have an administration that favors more government involvement, that's what you will get. And then that can then take away or create such a sour taste of being an owner. Right now, there are no landlord protections for those who are dealing with tenants who are not paying. So in this case, let's really talk about real life scenarios, right? Because we just did a webinar yesterday with a law firm that talked about rent control updates. And so if you're an owner of a property, let's say a 2 to 4 unit apartment or property, you live in one of the units, you have other tenants living in the others, you're carrying a mortgage that is relying on your tenants to pay you their rent, but they're not paying rent. So guess what happens? You're going to fall short. And right now, there's different stipulations and, different things, grants and raffles, and to help people get money to pay the landlord. But say none of that, it's not a perfect system right now, is what I'm wanting to make clear. This is not a perfect system right now. It's not a perfect protection in place right now for property owners. And so you get into this spiral of default, right? 1 month late, you're short, you're short, you're short. And there's nothing right now protecting you as an owner. So with that being said, we talked about all those options: repayment, restatement, forbearance. By the way, I'm going to investigate a little bit more on what's happening in the forbearance, because I am told, this is news breaking news today from an industry colleague, and more industry colleagues are learning this as we are navigating the sales of clients. I've not come across it yet, but if this is an issue, here's what's happened. We are learning that those who opted for forbearances, there was a separate loan created for those people. So it's now secondary lien on the property, and it has a separate stipulation that is coming to surprise. It's a surprise right now. And it's also, what I understood is, if you did forbearance, you would not receive negative reporting. I'm learning that those who did, there are some banks, lenders, or again, your mortgage servicer, that's why you need to know who your mortgage servicer is, are reporting negative reporting on your credit because of the forbearance option that you may have signed up for. Or if you were with Wells Fargo, I don't like to do that, but it's based on people that I know and I spoke to with Wells Fargo bank loans. Wells Fargo was automatically signing you up for forbearance unless you opted out. So you have to double check. You know, it sounds good and great if they come to you and say, hey, you don't have to worry about next month's mortgage payment. But listen, if you don't have it today, are you going to have it all in 6 months? One shot, one whop, boom. You know, this is why we're having this discussion, is because these are ways to empower yourself. What questions should you be asking? What should you be thinking? What does the end game look like? Always ask, what does the end game look like? Okay. So as we talk about deed in lieu of foreclosure, the question is, you cannot afford your monthly mortgage payment, right? So is this you? You cannot afford your monthly mortgage payment. A. B, would you like to sell your home, but you prefer not to participate in the selling process? We talked 2 weeks ago, we talked about short sale, and that's a process. So that's you being involved. You don't mind. The lender orders a BPO, broker price opinion, helps you set a price because, again, you owe more than the property's worth. Property hits the market. You negotiate with the buyer. The buyer has to wait for the bank to approve the purchase price. Again, that whole process. But in this case, let's say you have equity, right? And let's say you're ready to pretty much walk away. This is kind of the act of the walk away. You're ready to walk away, clean slate, and just reset and say, you know what, I'm done. I'm going to go ahead and give it back. And that's essentially what it is. You are giving it back. So you give back the deed in lieu of the foreclosure. So you say, I don't want to go through the legal process. I don't want you to sue me, is really what it is, right? I don't want you to sue me. So if the answer is yes, then you'll work with the servicer, your mortgage servicer, to relinquish ownership in exchange to be relieved from some or all of the mortgage debt. I recommend you speak to your tax advisor and or accountant as it relates to quote unquote relief of debt. Because the rule of thumb during the last administration, they said that they would forgive $100,000 of the amount. Those changes, those stipulations or protections expired. So now definitely check with your accountant if you are going to do a deed in lieu of foreclosure, and what does that mean? And then same thing with a short sale, right? If you are going to settle for selling the property for less than what you owe, what does it mean as a tax implication? What does it mean for the amount that you do owe, or the remaining amount that you do owe? What happens to that? All right. So very important. Any questions, comments, feedback? Because I'm going to get into HUD counseling. I'll give you a moment to digest this information. I know it's a lot, really is. And thanks for joining me on this late Wednesday evening. We're going to get ready to wrap this up soon. Um, Not meant to be a long segment today, but appreciate you wholeheartedly for showing up always. All right, so I'm going to give you some phone numbers, or a phone number. Listen, help is free 24 hours a day, 7 days a week. There are HUD approved housing counselors. They are available. So pass this information along, please. You should have this on speed dial, on the refrigerator. List of emergency phone numbers. You should have one when it comes to your mortgage if you're a property owner. If you are planning to be a property owner, you should know this information as well. Okay, so that number is, I'm going to read it out loud for my radio podcast listeners. Call 888-995-HOPE. That's 888-995-4673. Grady says that forbearance piece has me concerned for folks. Listen, I was concerned from the jump. I really was. The minute I heard it was going to come down, I already knew it was going to create issues. But more importantly, what it told me, there were two things that happened during COVID that told me we are kicking the can down the road. As a matter of fact, California, I'm in California, the governor here passed a new law immediately. Boom. And what it did was it actually put a protection in place, and it deters, I won't say block, it deters investors from doing bulk purchases of mass properties. It said in the event of a mass foreclosure, it deters them by way of pretty much making them pay for every property that remains vacant, deferred maintenance, they'll endorse city fines and stuff like that. And so when I saw that come down, I saw forbearance, this forbearance went into effect immediately, this emergency plan, and it was extended from, September to December to now January. What that told me is we're kicking the can down the road. What does that mean? Since 2008, you guys, we've had a band-aid over our economy. We've had a band-aid over our economy for a very long time. We've not ever let this economy adjust, rightfully so. We are on a tilt, and it's leaning in the direction where it's benefiting a lot of the investor. When I say investors, I'm referring to those who are in the business of making loans, selling and buying loans, right? Portfolio loans, Wall Street, in other words, right? And so as I look at homeowners, are the pawns in this game. And I say that because I see it all the time. I look at the situations people are in, and then I look at what they signed up for. When I look at what the council people have done by way of, let's say this home energy renovation opportunity, these energy efficient programs, California has it, Florida has it. When I look at some of the states that ties utilities to your property by way, if you don't pay your utilities on time, that a utility company can record a lien against your house. When I see things like that written, owners are pawns in this game, in this business. It's almost set up for you to lose if you don't really understand it. And it's unfortunate, which is why I think real estate literacy is key. It's one thing to be a home ownership advocate, but I'm a real estate literacy advocate. The education, the understanding of this information, because it's, we want to be advocates for everybody to be an owner, but not everyone is cut out to be an owner. And I can say that respectfully so, is because as I watch properties that I'm managing, I'm seeing the situations, and people are not educated on how much it is to maintain a property. It's one thing to own it. Even if you own it free and clear, there's that thing called maintenance. And the city can come fine you if your neighbors report the fact that your lawn is overgrowing, or you've got too many cars sitting on your lawn. I mean, you guys know the stories. You know the stories. You know what's going on. You know what's going on. So, Grady, thank you for sharing that input. Any other comments? I love this. I love that you're paying attention and you know what's going on, and listening to today's show will get you thinking, right? I need you to get your wheels thinking. Tamika asks, once liens are placed on a property, can one simply pay to have it removed? Anything more needed? That's a great question. So yes, you can pay to have them removed, but please write this down. Request a release of lien. Release of lien. Drop it in the notes in here for people. It's a great question. Let me bring that up again. Yes, pay the lien, but then you've got to request a release of lien and have them record it with the county clerks, your registrar's office, your records office. Ask for them to record it, or make sure you get a copy so that it can be recorded. They've got to give you the release of lien. It needs to be signed and notarized. I trust that is going to be consistent, that it is to be notarized no matter what state you're in. So release of lien. Okay, great question. Get the release of lien. Release of lien. Make sure when you pay it, because the release of lien is proof that you paid it. Or else guess what happens? You're going to call Lisa and you're going to say, I paid this off. I'm now trying to sell. I'm trying to refinance, but this lien is on my property. I can't do anything about it. What do I do? Well, when you stipulate paying, please add, just like when you settle with credit card companies or vendors or creditors, when you say, I'm going to settle this or I'm going to pay this off and I need you to report this on my credit as settled and paid in full, or whatever and I trust that you guys know this. Some of you may not, but you should be requesting this type of language. So same way you handle the creditors, same thing you handle the release of lien. You are saying with this payment, you are recording a release of lien. All right. Good stuff. Great question. Tamika says, thank you. Absolutely. All right. Any more other questions? Good stuff. Good stuff as we continue. So help is free 24 hours a day, 7 days a week for those of you who are experiencing that. Let's jump into, I think I've got some goodies for you. Yep. Top 5 tips to monitor your mortgage. Remember, we talked about the difference between mortgage lender and mortgage servicer. Number 1, write it down. All right. So these are my top 5 tips. This is what I do in my business. This is what I empower my clients to do. When they come to my office, they sit with me, they come hang out with me. They say, I'm in a situation. What do I do? And I walk them through this. They, get a notebook. I use an Excel sheet, date, time, call log, phone number, or email, who I've talked to, when I talked to them, what did I say, what was said, what are they going to do, when is it due by, right? Follow actions. Very important. You should be doing this anyway in life, just period. Writing this stuff down. All right. So number 1, write it down. Make notes so that it's reflected on your mortgage statement. What does that mean? So when you are calling your mortgage servicer, who? Your mortgage servicer, because you're not calling unless the mortgage servicer is also the mortgage lender. For example, Bank of America. They will keep some loans, right? We call those portfolio loans. They will keep some loans. They will service the loans, and they are also the lender. So you will deal directly with them. They have various departments. Make sure you're writing it down. If you're calling about, whatever, did you receive my payment? I have a question. My escrow account is showing that it's short. That's a very common question, or that leads to confusion for a lot of homeowners, is that my escrow account is short. I got the statement saying that my escrow account is short. I don't know what that means. What that means is something increased. So meaning there's more money going out than you bringing into them to pay your bill, right? Property taxes, insurance, and mortgage. So when I say this, let me be clear, because a lot of people will say your payments are going to be fixed. Oh, get a 30-year fixed mortgage. Your payment's going to be fixed. That's a misconception. Oh, how many are surprised that I said that? Your payments are not fixed. Your payment, your mortgage payment is not fixed, even if you have a fixed interest rate mortgage. Why am I saying that? Why am I saying that? Some of you might know this answer already. Your mortgage payment is not fixed, people. Your interest rate may be fixed. So you have an option between an adjustable rate mortgage and an interest rate on a fixed rate. Tamika says, nope. Payments are not fixed. Exactly. Which is why the surprise comes when your escrow account is short. Why would that be? because this thing called property taxes. Property taxes increases, thereby increasing your mortgage payment. Your property insurance might increase, thereby increasing your mortgage payments. You follow? This might be a new one for some of you. Grady adds fixed versus variable, but fixed could mean the rate. Exactly. Exactly. Fixed means your rate is fixed, your fixed interest rate. Means if today you signed on, you locked in your interest rate at my client, I saw she got a 2.78. I think it's when I looked at some paperwork last week. So fixed interest rate at 2.78. She has a fixed interest rate loan, a 30-year fixed interest rate loan at 2.78. But that does not mean her payments are fixed. Why? Is because this little thing we call property taxes and homeowners insurance. Those items are going to make your payments go up and down, right? If you change your insurance coverage, you add more coverage to your policy, your rate will go up, thereby increasing your payment. If your payments are impounded, what does that mean? That means your property taxes, your principal and interest, and homeowners insurance are all included. So drop that in the comments below, PITI. When I'm referring to payments, I'm referring to your PITI, not the rapper. PITI. That's the real estate rapper. PITI. Hey. Yep. Grady adds, taken directly and paid twice per year. And so when Grady says taken directly and paid twice per year, yeah, that means the escrow account that is created for your loan, your bills, in other words, is paying things in advance. They're paying the annual property your property insurance or your homeowner's insurance. They're paying that in advance. They get your property tax statements. They're paying that in advance. They're also getting the estimate, and they're calculating based on what we're seeing. Your property taxes could be an estimate of this amount. So we need to make sure your escrow account has enough money to pay these bills. So even though they're paid twice per year, and let me share with you how I remember property tax payments. It's NDFA. When it comes to your property taxes, there's no darn fooling around. When it comes to your property taxes, there's no darn fooling around. Your first installment is due November 10th. It is late December 10th, which is my birthday, so I won't ever forget that. The second installment or payment is due February 10th, and it is late April 10th. So when it comes to your property taxes, guess what? There's no darn fooling around. What I said down below here. November 10th, December 10th, February 10th, April 10th. Know those dates. All right. Penalties and fees apply. Interest apply. I've got some clients who are past due. I've actually helped and assisted some folks reinstate their past due property taxes here in California. If you do not pay your property taxes for 5 years, it will be sold off at an auction. All right. So again, NDFA, when it comes to your property taxes, no darn fooling around. Tamika has a question. Is it always paid twice per year? That's new to me. No, they're paying it in advance annually, right? So they're taking those 2 installments. They paid a year, and it's impounded. Impounded. impounded, which is why I said PITI. A lot of our elders and seniors who have properties paid off, or they didn't do it the way we do it now with PITI. They didn't have all this fanciness. They were still responsible for their property taxes. And so at the point that you have a property that is free and clear and no mortgage, you are responsible for your tax statement, and it's due and paid in 2 installments. So when it comes to your taxes, no darn fooling around. Check your tax statements. All right. Good stuff. Okay. Number 2, my second tip, top tips. Read each monthly mortgage statement. Why am I saying read? Read each monthly mortgage statement. The reason being is because you are assuming that your statements are saying the same thing every month. Number 1, you're checking. What are you checking for? What are you checking for? You're checking that your payment was applied. You're checking for your payment applied. Was it applied? Number 2, you want to make sure that your statement reflects anything that you questioned or you spoke to a rep about, and they didn't credit you an amount, they owed you an amount. You want to see that that was reflected. Remember, go to part 1, top tip 1, write it down, make notes so that it's reflected on your mortgage statement. You want to make sure that information is showing up. Also, here's why you read each monthly mortgage statement. Because if you have a balloon payment that's coming due, guess what? It'll say it right there when your balloon payment is due. I had a client who came to me and said the lender will no longer accept, they won't accept my payment. I sent them my mortgage payment and they sent it back. They won't accept it. I don't understand. Guess what? I found out and I said, well, let me take a look at your mortgage statement. And I look at the mortgage statement. And the reason why the lender was not accepting her monthly payment was because the balloon payment was now due. In her example, her situation, that means her mortgage was no longer $1,100 a month. It was now the full balance of $120,000. Read your mortgage statement, because that statement was alerting her every month that your balloon payment is coming due. Your mortgage is now coming due in full. Your mortgage statement has a little box on there that says messages, notifications, disclosures, right? Hey, we're going to communicate with you. That's how they're communicating with you. That's how they're keeping you on point on what's going on. What's also important to reference as well on your mortgage statement is who is the loan, whose name is the loan in, forgive me, whose name is the loan in. Okay, so make sure, if you know you have another owner or joint owner, someone else signed for that loan, make sure their name is reflected on that. Because that means if they're not, that means potentially only you are liable for this loan and the other person is not. Same thing. I'm dealing a lot with this. Those whose parents are passing away and the estate is now, responsible for the loan. Make sure that it's in the name of the estate. Don't let the mortgage servicers, pull one on you and put it in your name. Doesn't work like that unless you apply to assume the loan. But that's a process. You have to apply to assume the loan into your name. Otherwise, the estate or the living trust is responsible for the loan. Okay? It's so important. I'm seeing that more and more. It's so important. Okay? The third one, please check your credit reports. Where do we check our credit reports for free? It is federally mandated that you get access to your credit report for free from all 3 credit bureaus or credit agencies. And where is it that we do that? Pop quiz. Here's mine, my request right now. Can't see that. But I'm sending out a piece of mail right now because I said on the show, I found out somebody is using my identity. So now I have to, prove that it's me. And then I got to go through that process of, flagging my credit profile and, filing, that someone's using my identity and fraud and that kind of stuff. So it's important. It's important that you know, where do you access your free credit report? The answer is annualcreditreport.com. Make note of that. For those of you who have young adults, please make sure they know this. By the way, I have confirmation that the boot camps are starting up. Woohoo! I just got the email today. We start December 21st through January 8th. December 21st through January 8th. I just confirmed my class dates, Monday and Wednesdays from 12:30 to 2:30. Get at me if you want your young folks to be part of these boot camps where they're learning real estate literacy. Excited. Yay. Tamika says, yay. Exactly. I thought you'd like that. I'm like so stoked about that too. So I'm really excited about that. We just had a great boot camp earlier this summer, knocked it out the park. They've asked me to come back and, be a regular, have our regular boot camp. And I'm excited. So dates again, December 21st for our youth boot camps. And I think as young as, we've had, I think they were like 9 all the way up to 24, 9 to 24. Stay tuned. I don't have the link or the sign up stuff yet. I just got the email today, and that was really nice. So, December 21st to January 8th. My class dates are Mondays and Wednesdays, 12:30 to 2:30 Pacific time. And yeah, that's gonna be virtual. So good stuff. So we'll do that, and it'll, the good news is we're committed to rolling out those boot camps. The more people know, the better. And we're able to offer more, classes and sessions to our young folks. So that's going to be good. So good stuff. All right. So we're checking our credit reports at annualcreditreport.com. For those of you who are tuning in and for the first time and unfamiliar about the 3 credit bureaus, their 3 credit agencies are Equifax, TransUnion, and Experian. So Equifax, Experian, type this in for you, TransUnion, and Experian. So it is federally mandated, okay? So the reason being is because we know that identity theft and fraud is prevalent. And it's important for people to know how to double check, make sure your identity is not being used. How do you do that? How do you find out what information is being reported on your credit report? You should be monitoring that once a year at minimum, once a year. So Equifax, TransUnion, and Experian, you can access that at annualcreditreport.com. That is the only legit website that is mandated to offer you that information. The only. It's not freecreditreport.com. It's not, creditreport.com. It is annualcreditreport.com. That is the only legit website that is allowing you to access your credit report for free once a year. Okay, once a year. Good stuff. If you didn't know that information, let me know if that was helpful. Number 4, confirm or continue to pay your property taxes and insurance. This is, how we monitor your mortgage. Listen, because some of you may not have an escrow account where your property insurance, where your principal and interest, taxes and insurance are impounded. So I'm finding out that when some people have refinanced their mortgages and they were trying to do it to get a lower interest rate at that time, uh, and unfortunately, I think it's purposely masked, right? So when someone says, oh, what's your mortgage? You say, oh, I'm paying 1800. They say, oh, I could bring it down. I could, give you a $1,100 mortgage payment. And you go, wow, that's great. I'm going to do this. Let's do it. And you refinance. But here's why it's 1,100 sometimes, right? It's not just that you got a better rate. I trust that you did get a better or lower interest rate. What they didn't tell you was that they are not going to include your property taxes and insurance. And it means that you now responsible for paying them directly to those vendors, right? Directly to the tax county assessor's office and directly to the homeowner property insurance company of your choice. That makes a significant difference. Yeah, of course. So now you're looking at your principal and interest is just 1,100, but what about your taxes and insurance? What happened to that? And so it's important that we continue that dialogue, not just within our family, but for our children as it relates to transferring wealth and inheritance, that, hey, when that bill comes, please pay the property taxes. When the insurance bill comes, please pay the property insurance. I was able to, I joyfully assisted a client get connected. I referred her to an attorney, and she was able to actually, she was an heir to an estate of a property that burned down. The owner passed away. The estate went through probate. There was an insurance settlement. So listen to this, pay attention. This is important information. There was a settlement of an insurance payment for the claim of the burned house. She was due some funds. As an heir, she was able to receive her share. This is why insurance is important. Without insurance, there is no money to recoup, right? You just now have a burned house sitting on a lot. And that insurance, depending on your policy, depending on your coverage, is designed to either rebuild the home, using current materials, same square footage, etc. But you have to know that information. Your property insurance says in the event of a fire damage, we're going to replace what? Is it a full replacement cost? Talk to a property insurance expert about that. Will it include building back the house using today's materials? And then there's your personal items, right? If you had your, 65-inch TV, you had your sub-zero freezer, and you had all these wonderful appliances and everything else that's included, this expensive furniture. Do you have those items insured? Do you have an inventory of those items? You should keep an inventory of those items, and you should keep footage, pictures, videos of those items. Just go take a picture of what your closet looks like so you can account for and say, this is how much clothes I had in my closet. This is what it's worth, right? I estimate this is what it's worth. I have my computer, my office, my this, my that, my printer, my scanner. Take a picture. This is what it's worth. You should create an inventory. See, this is why I say most people are not aware, right, of or privy how much involved real estate is. It's not just the outside, it's also the inside. So take that video. Great. Grady says, yes, he agrees. Video. Do the video. Walk through. I agree. It's much easier than taking pictures. Take that video, upload that video to, a cloud or backup drive. And you should have a copy of the backup drive somewhere else outside of the property, right? So either cloud storage or offsite from the property, because in the event that property is damaged, the drive is damaged, you don't have footage of the inventory. You have no accounting of it. All right. So confirm and continue to pay your property taxes and insurance. All right. Please do so. Please pay attention to those bills that come through. Number 5, and the last one, is keep lines of communication open with the mortgage servicer. Yes. Tamika adds also, as we're talking about inventory of your property, she says save digital receipts. I agree. And that's so much easier now. There's no excuse. Although I'm not consistent, so I'm guilty. My husband says that all the time. I think I'm going to task him with it because he's far better than I am with it. Thank goodness I have him in my life because he looks at me like, what are you doing with all these receipts? Honey, honey, that's what you're here for. That's what you're here for. All right. And to me, that's funny because for those of you, I'm recently married. So it's, could you imagine? We have these jokes, between each other, like, gosh, what would I have done without you, right? Like, where you been all my life? Number 5, keep lines of communication open with your mortgage servicer. What does that mean? Hey, if you're going through stuff, you're going to be late, you need to call them. You change a mailing address, you need to call them. You're making changes, you don't understand something, document. Write it down. Ask the questions. Keep the lines of communication open with the mortgage servicer. Because if they don't hear from you, they don't know how to help you. And I would suggest this goes back to getting your top 5. Let's talk about top 5 real quick, and then we're going to wrap this up. Thank you guys for hanging out. I mean, I went over time, but you guys have great comments and questions, as we're concluding our empowerment series, our homeowner, property owner empowerment series. Listen, get with your top 5, because as I'm able to share this with you because I'm somebody's top 5. We don't know what we don't know, right? Most people don't know what questions to ask. It's so funny as I'm dealing with a lot of the legal questions and situations and jargons as it relates to different aspects of my client's life and my life. You don't know what questions to ask, so get with a professional. So your top 5, who should your top 5 be? When I talk about my top 5, I'm not talking about, Chris's top 5. Your primary care physician or holistic doctor, your tax advisor or your accountant, your insurance advisor, your attorney, and your real estate professional, broker, or agent. This is your mind, body, and spirit right here. These are the people that are protecting you, overseeing your best interests. Your mind, body, and spirit. I'm talking about your wealth. Talking about your wealth. Right? Your health is your wealth. So you should have the primary care physician, your holistic doctor, your tax advisor, your accountant, your insurance advisor, your legal team, and your real estate team. You should have your top 5. It's a non-negotiable. It's a given. It's a given. Grady says your bail team. That's right. Exactly. Tamika adds, Grady, I like that. I agree. Your bail team. I call you your top 5, your mind, body, spirit right here, right? Boom. Together we are stronger. These fingers together we're stronger. All right. We're going to wrap this up. Listen, if you want a copy of the CFPB, this is the Consumer Financial Protection Bureau, offers a homeowner's guide to success. This is where I'm actually getting this information. I'm concluding it today. It's a wrap. We're going to focus on some other topics as it relates to investing, hard money loans. There's a lot of things I'm seeing we need to talk about. So I'm really excited, which is great, because right now I'm dealing more and more with investors and developers. It gives me a lot of insight that I'm so happy to share with you all in terms of negotiating, selling, and buying and all that fun stuff. So if you'd like the Homeowner's Guide to Success, it actually has a budget sheet in there. I think you should be, keeping track of your expenses. I do find, not oftentimes, but I see that when people purchase property, it seems for some reason they accumulate more debt. And then when you get into a financial hardship, guess what? That's the first thing the lender or the mortgage servicer is asking on behalf of the investor or the mortgage lender. They want to see, where's your money going? So if you're eating out regularly, you're spending out, you got all these extra subscriptions to, Netflix, Disney, Hulu, all these other platforms. Listen, tighten up on your money. You've got to tighten up. We call this period right now expense optimization. You should be optimizing your expenses. It's crunch time. It's crunch time. Tighten up on the expenses. There are some things that you don't need right now. All right, let's tighten up. You should be living like that anyway, which is not above your means. That's pretty much what I'm saying. All right, with that, I say, listen, thank you so much for joining me tonight. You guys have been awesome. Make sure you share and pass the word along. Let somebody else know what we're doing here on Ready, Set, Real Estate. And I will see you next week. Oh, I may see you Saturday, but I'm tentative. I just got to look at the schedule. But Saturday, we're going to have the class on deed fraud, deed and mortgage fraud. We should talk about that, give you some tools and tips on how to protect yourself, what to look out for, and stay tuned for that. With that, I say have a powerful and productive week. I'll see you next time. Hey, all right. Grady says thank you. Absolutely. Thank you.